The US dollar has just fallen to a 4-month low. At the exact same time, gold has shattered every record in human history, crossing $5,000 per ounce for the very first time. And if that wasn't shocking enough, something happened this same week that we have not seen in 30 years. For the first time in decades, central banks now officially hold more wealth in physical gold than in US government bonds. Think about that for a moment, like 3 massive financial events, all happening within a single 72-hour window. This is not coincidence, this is not normal market volatility, and this is definitely not a temporary correction. This is the structural collapse of dollar dominance, happening in real time. But what makes this moment truly historic is not just the event, it's the speed. When the Roman Empire's currency began to fail, it took nearly 200 years for the empire to collapse. When the British pound lost its global reserve status after World War I, that decline took around 30 years. But the US dollar, it is losing global credibility in just 30 months. From February 2024, when the first cracks quietly appeared, to January 2026, when central banks officially began abandoning US Treasuries in favor of gold. 30 months, that is the entire timeline of what could become the greatest monetary transition in modern history. And here's the part most people still don't understand. We are only halfway through. Over the next few minutes, you're going to see exactly what these 3 simultaneous events really mean, why the next 18 months may be the most critical financial window of our lifetime, and what typically happens when the world's reserve currency collapses faster than any major currency ever recorded. Because this story is not just about gold prices, it's not just about exchange rates. This is about the possible ending of the financial system that has defined your entire life. And the dangerous reality, most people will not recognize what's happening until the consequences have already reached them. So let me begin with a single number, a number so powerful, it changes everything. Gold is now worth $5,000 per ounce. $5,000 for a single ounce of metal. Pause for a moment and put that into perspective. In January 2000, gold traded at just $280 per ounce. By January 2020, it had climbed to roughly $1,500 per ounce. In January 2025, gold reached around $2,650 per ounce. And now, in January 2026, gold stands at $5,000 per ounce. That represents a staggering 1,686% increase since the year 2000. But what's even more shocking, gold surged nearly 89% in just 1 year, from January 2025 to January 2026. Moves like this are not normal, they are not casual market behavior. But here is what truly separates this moment from every other gold rally in history. This is not speculation, this is not retail investors chasing momentum, this is not hedge funds placing leveraged bets, this is central banks, the most conservative, most risk-averse, most calculated financial institutions on earth. And right now, they are buying gold at a pace we have never witnessed before. In 2025 alone, central banks added over 1,000 tons of gold to their reserves. Let that sink in. This marks the 3rd consecutive year where purchases crossed the 1,000-ton level, 3 straight years, record-breaking accumulation. And the pace is not slowing, it is accelerating. Which raises a question you cannot afford to ignore. Why are the world's most sophisticated financial institutions, the very entities responsible for protecting the wealth of entire nations, buying gold as if the global financial system is entering dangerous territory? Because they have access to data you will probably never see. They understand mathematical realities that are never discussed on mainstream financial media. And more importantly, they know that with increasing certainty that the US dollar system is entering what many would call terminal decline. So what exactly are they seeing? Let's break it down. For the first time since 1996, nearly 30 years, central banks around the world now hold more value in gold than in US Treasury bonds. Global gold reserves currently stand at roughly $4 trillion in market value. Meanwhile, foreign central bank holdings of US Treasuries have fallen to about $3.9 trillion. Gold has officially overtaken US government debt as the world's primary reserve asset. Pause for a moment and truly think about what that means. For your entire adult life, the very foundation of the global financial system rested on US Treasury bonds. Every country held dollars, every central bank accumulated treasuries. They were considered the safest, most liquid, most dependable asset on the planet, the bedrock of global finance. And then, in a single week in January 2026, that 30-year era quietly came to an end. Central banks looked at 2 choices: promises backed by the US government or physical metal locked inside a vault. They chose the metal. That is not simple diversification, that is a vote of no confidence in the United States. Think of it this way. This is the financial equivalent of your spouse secretly moving money out of your shared bank account and placing it into a private safe deposit box you cannot access. It signals preparation, preparation for separation, preparation for collapse. In this case, the separation is global central banks distancing themselves from the dollar system before instability accelerates. Now, the next question becomes critical. Who is driving this shift, and what does it reveal about the timeline ahead? Let's start with China. China is currently the largest buyer of gold in the world, although the official numbers likely do not tell the full story. Official Chinese gold reserves sit at approximately 2,264 tons. But when analysts examine import flows, undisclosed purchases, and long-term accumulation patterns, the estimated real figure climbs to over 5,000 tons. China has quietly more than doubled its reserves through what many describe as shadow accumulation. Why would they do this? Because they are positioning themselves for a post-dollar world. And here's what makes the strategy even more revealing. China is not only buying gold, they are aggressively reducing exposure to US debt. At its peak, China held nearly $1.3 trillion in US Treasury bonds. As of January 2026, that number has dropped to around $680 billion. That is a 48% reduction. Over $600 billion in US government debt has been offloaded in less than a decade. But the pace of selling has accelerated sharply through 2025 and into 2026. This is not passive portfolio management, this is active, deliberate, large-scale de-dollarization by the world's second largest economy. Yet even China's strategy looks measured compared to Russia. After the United States froze roughly $300 billion of Russian reserves in 2022, Russia responded decisively. They sold virtually every US Treasury bond they owned, dropping from about $150 billion to under $10 billion, a near total exit. And where did that capital go? Gold. Since Western sanctions began in 2014, Russia has increased its gold reserves by more than 1,500 tons. They recognized the warning signs nearly a decade ago and positioned themselves accordingly, but this movement is no longer limited to geopolitical rivals. The pattern is spreading. India added over 200 tons of gold in 2025. Turkey continues aggressive accumulation. Qatar, despite its relatively small size, is stacking gold with unusual urgency. Poland, Singapore, and the Czech Republic are increasing reserves. Across Asia, Eastern Europe, and the Middle East, nations are buying gold at record speed and at the same time reducing their holdings of US Treasuries. Even Japan, America's closest ally in Asia and historically one of the largest foreign holders of US debt, has now become a net seller. But Japan's motivation is slightly different. They are selling treasuries in order to defend the yen. And when even your strongest allies begin stepping back from your debt, markets pay attention. Saudi Arabia, the cornerstone of the petrodollar system for 50 years, is reducing its treasury holdings. Europe is selling off assets to fund defense spending increases. The buyers, gone. The entire world is moving in one direction, out of dollar assets and into gold. This is not a trend, this is a stampede. And when you understand why they are stampeding, you understand the timeline for what comes next. Let me show you the 3 reasons central banks are fleeing dollars for gold, because these reasons reveal exactly when the crisis will go critical. Reason 1, the US dollar just crashed to a 4-month low. The dollar index, which measures the US dollar against a basket of major currencies, just hit levels not seen since September 2022, and it's falling even as the Federal Reserve keeps interest rates elevated. Normally, high interest rates strengthen a currency because foreign investors flock to earn the higher yield. But right now, even with rates at 4.5% to 5%, the dollar is weakening. Why? Because the market is pricing in the mathematical certainty that the Fed will have to restart money printing soon. The US government has $38 trillion in debt. Annual deficits exceed $2 trillion. Interest payments on the debt have just crossed $1.2 trillion per year, more than the entire defense budget. And this is growing exponentially as old debt matures and is refinanced at higher rates. The math does not work. Tax revenues are about $4.9 trillion per year. Mandatory spending, Social Security, Medicare, Medicaid, and interest payments alone is approaching $4 trillion. That leaves barely $1 trillion for everything else: defense, infrastructure, education, everything. The government is mathematically insolvent, so what happens next? The Federal Reserve will be forced to restart quantitative easing. They will print trillions of dollars to buy treasury bonds that foreign central banks refuse to hold. This is debt monetization, It's what Weimar Germany did. It's what Zimbabwe did. It's what Venezuela did. And every single time, it ends the same way: currency collapse. Foreign central banks see this coming. They are not waiting for any official announcement. They are exiting now. Reason 2. Sanctions weaponization has created existential terror. In February 2022, the US and European allies froze over $300 billion in Russian central bank reserves. Russia had accumulated those reserves over decades, holding them in Western banks in dollars and euros as a safety net. And overnight, with a few signatures, that wealth became inaccessible. The US didn't seize it legally through the courts, they just froze it, declared it off limits. And it remains frozen today. Every central banker on Earth saw this and thought the same thing. If they can do that to Russia, they can do it to us. China looked at their $3 trillion in dollar reserves and realized, if there's a conflict over Taiwan, the US will freeze all of it. Saudi Arabia saw decades of dollar recycling from oil sales and realized those dollars were hostages, not assets. India, Turkey, Brazil, Indonesia, every country holding dollars had the same epiphany. Dollars held in the Western financial system can be confiscated at any moment for any political reason. There is no safety, no rule of law, only political power. And that realization changed everything. Because the entire premise of a reserve currency is trust. You hold dollars because you trust they will be honored, maintain value, be accessible when needed. That trust is now permanently shattered. And once trust is gone, you move your wealth into assets that can't be frozen, can't be sanctioned, can't be seized by a foreign government. Gold stored in your own vault is that asset. China cannot freeze Russia's gold. America cannot freeze China's gold. Physical gold stored domestically is sovereign wealth, impossible for adversaries to weaponize. This is why central banks are buying gold at record rates. They are building financial sovereignty in a world where the dollar has become a weapon rather than a neutral tool. Reason 3, US fiscal and political chaos is undeniable and accelerating. Just days ago, major European pension funds publicly announced they are dumping US Treasuries. Not quietly, not discreetly. They put out press releases explicitly stating, we are reducing US exposure due to Washington's political instability and fiscal irresponsibility. When pension funds, some of the most conservative institutional investors on Earth, openly declare the US government is too unstable to trust, that is game over for credibility. US debt to GDP ratio is now 128%. That's approaching the 130% threshold, where historically every empire faced systemic crisis within 5 to 10 years. Debt ceiling fights happen every 12 months, each bringing the country closer to default. Trade policies shift chaotically every few months. Economic policies flip-flop constantly. There is no plan, no strategy, no credibility. And foreign investors, they are watching this circus and pulling their capital out. Not slowly, rapidly. This is capital flight from the world's reserve currency. It's never happened before at this scale and speed, and it's accelerating. Now here's where it becomes mathematically inevitable and timeline specific. When foreign central banks stop buying US Treasuries, the debt spiral accelerates exponentially. Let's break down the cascade so you can understand the timeline. Stage 1, loss of foreign demand. We are here now. January 2026, foreign central banks are net sellers of US Treasuries. China, Russia, Japan, Saudi Arabia, Europe, all are selling or reducing holdings. This means when the US government needs to borrow $2 trillion this year, there aren't enough foreign buyers. Stage 2, yield spike. When demand falls, bond prices fall. When bond prices fall, yields rise. The US 10-year Treasury yield is currently 4.8%. If foreign selling continues, yields climb to 5.5%, then 6%, then 7%. Higher yields mean higher borrowing costs for the government. And interest expense explodes from $1.2 trillion to $1.8 trillion to $2.5 trillion annually. Stage 3, Fed intervention. When Treasury auctions start failing because there aren't enough buyers, the Federal Reserve steps in. They announce a new round of quantitative easing. They create trillions of dollars out of nothing and buy the treasuries that foreigners won't buy. This is the moment dollar credibility shatters completely. The world sees the US printing money to fund itself and trust collapses. Stage 4, dollar collapse. Foreign holders of dollars panic. If the Fed is printing trillions, their dollar assets will be inflated away. They sell everything dollar denominated. Treasuries, stocks, corporate bonds, cash, everything. The dollar loses 30% to 40% of its value in 12 to 18 months. Imports become unaffordable, inflation spikes to 15%, 20%, 30%, the American standard of living collapses. Stage 5, gold explosion. As the dollar collapses, gold becomes the only trusted store of value. Let me give you the month-by-month timeline based on current trajectories. 1/20/26 current phase dollar at 4-month lows. The timeline is 12 to 18 months from now, mid-2027 for the acute phase, that's your window. So what do you actually do? How do you position for a world where the dollar loses 40% of its value, is $12,000 per ounce, and inflation is running at 20% plus? First, physical precious metals. If you don't own gold or silver, buy now physical metal you can hold or store in a private vault. You control not ETFs, not mining stocks, not paper certificates. 10% to 20% of liquid net worth in precious metals is the standard allocation. Gold at $5,000 feels expensive. Fourth, build tangible resilience. The crisis won't just be financial, it'll be social and potentially violent. Stock 3 to 6 months of food, water, essentials. Have skills that produce real value. Medical, mechanical, agricultural, construction. Have community. Strong local networks matter more than paper wealth when systems fail. Fifth, watch the acceleration indicators. Gold breaking $6,000, panic intensifying. US 10-year Treasury, yield above 5.5%. Foreign buyers gone, dollar index breaking below 95. Sustained weakness, Fed announcing QE restart, debt monetization confirmed. Failed or weak Treasury auction, crisis imminent. Any of these signals accelerate positioning immediately. Let me bring this to a close with the core reality. The dollar hitting a 4-month low, gold breaking $5,000, and central banks favoring gold over treasuries all in the same week is no coincidence. It's confirmation. Confirmation that the shift from a dollar-based global system to something else has started. And it's happening faster than any currency transition in history. The British pound took 30 years to lose reserve status. After WWI, the dollar is losing it in 30 months. From early 2024, when cracks appeared, to mid-2027, when the crisis peaks in 30 months. Central banks see this, they have the data, they understand the math. US debt is unpayable, deficits are unsustainable, the political system is dysfunctional, the Fed will print, the dollar will collapse, and gold is the only asset that survives currency collapse. This pattern has repeated itself over and over. Rome debased currency, gold held value. Spain went bankrupt repeatedly, gold was the safe haven. Weimar Germany hyperinflated, gold owners survived. British pound lost reserve status, gold outperformed all. The pattern is clear, we're in it now, and the timeline is compressing. Gold at $5,000 is not the top, it's the beginning. The crisis phase, like when gold moves to 8,000, 12,000, 15,000 plus, will arrive in the next 12 to 18 months. You have a window measured in months to position before the acceleration phase. Most people won't act. They'll watch gold climb to $8,000 and say, I missed it. But the people who understand history, who recognize that central banks don't panic by 1,000 tons of gold per year, unless something catastrophic is coming, they will act now. And when the crisis hits, when the dollar collapses and inflation destroys purchasing power, they'll be the 5% who preserve wealth while 95% get wiped out. Which group will you be in? The choice you make in the next 90 days determines your financial survival for the next decade. If this analysis revealed what's really happening behind the headlines, subscribe immediately and turn on notifications. The next video breaks down the exact timeline month by month through 2027 with specific trigger points and actions to take at each stage.